Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. Today we discuss the extent of ASEAN's decoupling from a potential US recession and when Malaysia might hold its general elections now that the tabling of Budget 2023 has been brought forward. Winson Phoon, the head of fixed income research, moderates the call.
Hi, good morning everyone. It's 8 o'clock on Monday. A quick recap for last week. US stocks plunged on Friday after Chair Powell's speech at the Jackson Hole Forum. As he said, the Fed will likely need to maintain a restrictive policy stance for some time in order to restore price stability, and he warned against prematurely loosening policy. The S&P 500 and Nasdaq indices fell more than 3%, the worst daily decline since mid-June. But interestingly, the reaction in US Treasury market was relatively mild. The 10-year yield was little change at 3.05% on the day. Currently, the Fed funds futures are pricing in more than 80% probability for another 75 bp hike in September and a peak rate of 3.8% by early 2023. In ASEAN, stock market performance was mixed. Thailand index still ended higher by about 1%, despite the political uncertainty after the Constitutional Court has suspended Prime Minister Prayut from his official duties pending a review on his 8-year term limit. US and China reached a prelim deal to allow US regulator to review audit documents of Chinese companies in the US, easing concerns on the delisting of about 200 firms in the New York exchanges. In China, the government adds another 1 trillion stimulus to support the economy and the property sector. Loan prime rates were also cut by 5 bp for the 1 year and 15 bp for the 5-year tenor. Bank Indonesia hiked rate by 25 bp. The central bank also raised its inflation forecast, but announced an operation twist in its bond purchase program, which allows selling short-term government bonds while buying long-term government bonds, anchoring the yield curve. On Malaysia, the tabling of budget has been brought forward by 3 weeks to the 7th of October, according to news report, raising speculation of an early election. Later we have Suhaimi to comment on this. And on Singapore, wearing masks will no longer be mandatory from today, including indoors, except on public transport and in healthcare facilities. Global commodity prices were broadly higher last week. A Brent crude price increased more than 4% to above $100 per barrel. Base metals, agriculture, and livestock commodities were all higher. Looking ahead this week, no central bank meeting, but we have Eurozone CPI on Wednesday and the US jobs report on Friday. And this morning we have Harbin, a thematic report on ASEAN decoupling from potential US recession risk, and also Singapore macro updates. We have Juye on Indonesia macro, Suhaimi on Malaysia budget date, Andy on ringgit and US dollar update, Han on Thailand equity portfolio, and Samuel on Grab results. Let's start with Harbin. ASEAN, you wrote a report that ASEAN is a defensive play amid rising US recession risk. What underpinned the relative resilience of ASEAN economies? I think you have 6 arguments on this. Do you see any differentiation within ASEAN, like which country will hold up better and which one will be more exposed in the event of a US recession?
Hey, hi, morning, Winson. So yeah, ASEAN, when you look back at the first half, is emerging as a defensive harbor and has partly decoupled from the US economic downturn and potential recession. So growth in the first half, ASEAN 5 GDP excluding Singapore was 5.4%, and it looks like it's going to hold up with about 5.3% in the second half by our estimates. And we're looking at 4.9% next year, despite slowing US, China global growth. Historically, growth in Singapore, Malaysia, and Thailand has been more correlated with the US business cycle because of their more, export-oriented, while growth in Indonesia, Philippines are far less correlated. So there are kind of 6 arguments why there may be a partial decoupling. One is the reopening boost is still not totally over, with accommodation and food services, construction, air transport, still well below pre-pandemic levels as ASEAN lives with COVID. Second point is actually strengthening intra-ASEAN trade. which is helping to partially offset weaker G3 and China trade. So in the first half, that was roughly about 30% year on year. And when you look at the share of intra-ASEAN trade, that's actually been rising over time. The third point is the rising FDI and shifting manufacturing supply chains to ASEAN. That seems to be playing out with very sharp increases, especially in Indonesia, particularly in manufacturing and some of the electric vehicle space, as well as Malaysia for electronics, Singapore as well, up 30% in the first half, and Vietnam still holding up pretty nicely. The only exception here is perhaps Thailand. And the fourth point is actually elevated in energy and food prices, which benefits energy exporters, Indo, Malaysia, and food exporters, Thailand, Malaysia, Indonesia, some of the CLMV countries as well. So even though recessions are deflationary, we don't think that some of these commodity prices will come off as much as in past recessions, or simply because of the reasons we've seen, right? The supply chain disruptions, the energy transition, as well as some of the climate change impact. The fifth point is the less aggressive interest rate hiking cycle in ASEAN, perhaps with the exception of Philippines and Singapore. But we've only seen Indonesia and Thailand hike once. Vietnam has not even hiked at all. Malaysia has hiked twice. And that's going to help cushion the impact, especially on the domestic demand side. And the sixth point is the relocation of headquarters and talent from Hong Kong and capital inflows from Greater China, simply because of the US-China ongoing geopolitical rivalry, which I don't think is going to end anytime soon at all, and the very divergent COVID strategies. So that's helping especially Singapore on the financial sector side. A big wild card, that could really help with the decoupling is, of course, the timing of China's reopening. We don't know whether it's end of this year or whether it's next year, but when it does, there could be a major boost to ASEAN's tourism exports.
And on the topic of US recession, which looks increasingly likely, and the US rates market is also implying a recession, pricing in a small rate cut from the second half of 2023. But interestingly, I think you mentioned this recession, if it were to happen, it likely would be a shallow rather than a deep one. Why is it the case, and how will this affect the US inflation outlook and Fed policy?
So, like you said, the probability of US recession over the next 12 months has risen. 26% probability based on our estimates of 3-month, 10-year term spread. So it's on the verge of inverting. But it looks as if the US recession this time may be shallow rather than deep, cushioned by labor shortages in the reopening sectors, as well as healthier household and corporate balance sheets. We look at the US household debt leverage today is about 67% of GDP. That's much lower than the 85% just before the GFC. When you look at the US households cash balance sheet, the good news is that they've amassed an estimated 2.6 trillion of excess savings during the pandemic, simply because they can't spend, stuck lockdowns, but have drawn down only about 160 billion. When we look at the non-financial US corporate debt, pretty high, 78% of GDP, actually slightly higher than the GFC ratio of 68%, but below the peak of 91% just 2 years back. So I think there's been some adjustment on the debt equity ratio simply because in anticipation of the Fed rate hikes and refinancing. Cash held by US companies have also ballooned to about 1.3 trillion from 840 billion. And of course, I think the US banks are a lot better capitalized owing to more stringent regulatory standards imposed in the wake of the GFC. So, our guess is that it will be a recession, but it's going to be shallow. But I think it could be prolonged, so a shallow but prolonged recession, simply because on the inflation side, we don't think it probably can fall as fast. When we calculate some of the numbers and the sacrifice ratio, using some of the past historical data, we estimate that unemployment rate will need to rise to about 6.3%, roughly from the 3.5% today, to fall to the Fed's 2% target. And the labor market is still pretty tight, suggesting that attaining wage growth to pre-pandemic levels is going to be difficult. So elevated inflation, I think, will make for a very, will constrain the Fed's policy response, which means that the rates will probably be higher for longer.
Some updates on Singapore macro. Inflation hit up again in July. Headline CPI jumped to 7%. But at the same time, manufacturing growth slowed sharply. And you mentioned there is a risk of a technical recession for Singapore in third quarter. How do you think these factors will affect MS monetary policy?
Yeah, so industrial production slowed quite dramatically, 0.6%, in part because of the plunge in semiconductors, electronics. So I think it's very obvious now that the global chip cycle, electronic cycle is hitting lower and actually quite quickly. So that in terms of technical recession, Singapore 2Q GDP was actually a negative Q on Q. And I think by our calculations, it looks like the real risk of another Q on Q contraction in the third quarter, given the very sharp plunge in some electronics production side. And the MAS faces a dilemma because in the face of a technical recession, at the same time, inflation is headed higher. Headline jumped to 7% in July, core is 4.8%. So it's basically at the top end of some MAS forecast inflation ranges really. So I don't think they really have a choice. Inflation is probably the priority. So come October at the meeting, they probably have to tighten again for the fifth time. And we are looking for a recentering of the Sing Nier towards the prevailing level of exchange rate.
Thanks, Harbin. Let's move to Indonesia. Joy, Bank Indonesia finally started rate tightening and raised the interest rate by 25 bp last week. It is the last central bank in ASEAN 5 to tighten. Before this, Bank Indonesia sounded pretty sanguine on Indonesia inflation outlook. What has changed? And there has been concern that Bank Indonesia has fallen behind the curve on policy tightening. Do we expect more aggressive hike ahead?
Hi, morning everyone. So during the monetary policy meeting last week, Governor Perry did state that this decision to hike was a preemptive step to mitigate the risk of rising core inflation, as well as inflation expectations because of the increase in non-subsidized fuel prices, as well as volatile food inflation. And as you mentioned, BI has raised its inflation forecast significantly. It's now looking at headline CPI to rise above 5% this year, compared to their previous estimate of 4.5 to 4.6%, whereas core CPI is forecasted at 4.2%, compared to their previous guidance of coming in within the 2 to 4% range. The governor highlighted that BI is seeing evidence of second round effects of the rise in energy and food prices. And he added that inflation next year may also breach BI's 2 to 4% target. We think that BI's substantial revision of its inflation forecast may also be incorporating somewhat a hike in subsidized fuel prices. We are still expecting the BI to deliver 2 more rate hikes this year, most likely in the fourth quarter. BI may pause in the September meeting, given that it's in the reserve requirement ratio for the final time to 9% from the current 7.5% in order to absorb liquidity. I'm looking at 2 more rate hikes in 2023 for BI.
On the topic of fuel subsidy, do you think the government is going to raise the Tata Light price soon? And what do you think is the impact on inflation?
Yep, the government has been revealing plans to hike subsidized fuel prices. The price of Pertalite, which is the most widely consumed fuel in Indonesia, accounting for 63% of total consumption, has stayed unchanged since 2019, and it's currently nearly half of the market price. And the finance minister cautioned last week that if fuel prices remain unchanged, the additional subsidy burden would rise by 40% to 700 trillion rupiah from the current allocation of 500 trillion rupiah. There was some guidance. The deputy chair of the Energy Committee stated in an interview this week that Pertamina is considering raising Pertamina prices by 30% to 10,000 rupiah per litre, and diesel prices by 40% to 7,200 per litre. And we estimate that a 30% hike in Pertalite price would add around 2 percentage points to headline CPI and 0.8 percentage points to core CPI. We recently raised our inflation forecast for headline CPI, the base case to 4.8% from the previous 3.9% for this year, and to 4% from the previous 3% in 2023. But under a 30% hike scenario, we would see much faster inflation, In this case, we would look at headline CPI at 5.2 this year and 6% for 2023. I also want to add that the fuel price hike would also likely prompt PI to hike at a much faster pace, possibly by an additional 25 or 50 bips this year on top of our base case of 75 bips. And for 2023, it may also hike by another 50 bips on top of our base case of 50 bips. And that could bring the policy rate to as high as 5.75%. That would be the highest since 2019 by end of next year.
Thanks, Julie. We'll move to Malaysia. Suhaimi, according to a news report, the tabling of budget 2023 has been brought forward to 7th of October, and speculation is rife that GE15 may come early in November. What is your thought on this?
Hi, morning everyone. As you said, budget 2023 will be tabled on 7th October, 3 weeks earlier than the original date of 28th October this year. This means Parliament session will be brought forward from the original 26 October to 15 December. Parliament Speaker to give MPs at least 28 days notice of the new dates, suggesting late September or early October session for the next Parliament sitting. 15th January election is due anytime between now until the Parliament's 5-year term ends in mid-July 2023. And was only one general election that happened soon after the tabling of budget, such that there wasn't enough time to debate and pass the budget. And that was the 10th general election in 1999. Budget for the year 2000 was tabled on 29 October 99. Parliament was dissolved on 11 November 99, and polling date was on 29 November 99. And after general election, Parliament reconvened for a special session just before Christmas of that year to table and pass supplementary supply bill for government expenditure on essentials like civil service salaries, pensions, and debt service charges for early 2000. Budget 2000 itself was retabled on 25th February 2000 and passed on 12th April 2000. So we may be looking at that scenario again this time around.
Do you think an early election will affect our views or forecasts on growth, inflation, or the OPR?
Regardless of the timing of next GE, I mean, for now, we are leaving our growth, inflation, and interest rate forecast unchanged. To recap, we expect real GDP growth to pick up from 3.1% last year to 6% this year before easing to 4% next year. Inflation to accelerate from 2.5% last year to 3.4% this year and 4% next year. And we are pricing in another 75 basis point hikes in overnight policy rate from current 2.25% to return to pre-COVID-19 level of 3% by the first quarter of next year.
Thanks, Suhaimi. Still on Malaysia, we have Andy to update us on the ringgit. Andy, do you think it will break 450? I think a common question we usually get from foreign investor is why the ringgit hasn't held up as strong as the rupiah, despite both being the beneficiaries of higher commodity prices. And what is our outlook for the rest of the year?
Hi, morning, Winson. Indeed, like you mentioned, ringgit has, for example, weakened by about 7% year to date. If you compare rupiah, it is about half of it, more slightly above half of it, which is about 3.9% weaker only compared to the ringgit. I think there are a few reasons. In particular, in our piece that we just released last week, we highlighted two things which stood out, which is one, the broader dollar moves, which is the Fed stance, the haven demand moves, and which is in particular shown with the interest rate differential or policy rate differentials between the Fed and, of course, Bank Negara, which is quite significant because for Malaysia, our current policy rate is about 2.25% for Malaysia, compared to the Fed, which is already hiked already. And if you compare with Indonesia, which has a yield about higher, about 1.5% higher at 3.75%, They've already raised 25 basis points, and I think markets are expecting another 50 basis point hike by the end of the year. So a bit of the lag side of things have led to the widening policy differentials and led to some of the expected weakening on that front. The second factor is on the China front. The China macro outlook, I think, remains sort of soft and likely to remain a key driver for ringgit as well. For example, if you look at the moves after the Powell's announcement or speech last Friday, CNH or offshore CNY has actually broke the 690 level. It's currently at about 691 level. And if we look at our report, we found that China factor actually plays a significant role in affecting ringgit. In fact, China renminbi has actually weakened almost 7.5% year to date, somewhat close to what ringgit has actually moved, which is about 7%. So with renminbi, offshore renminbi, and renminbi being weaker, and possibly over this week as well, we would expect ringgit to continue to weaken. I would not rule out possibly ringgit definitely breaching 450 anytime soon if the renminbi approaches the 7 level on the offshore, and also beyond 690 for the CNY currency as well. So those two factors, I think, differentiate somewhat in terms of the correlations or relationships between some of these factors compared to the rupiah, despite the commodity sort of underpinnings which are similar for both sides as well, even with oil actually strengthening and actually softening now as well. Winston?
How about the US dollar? The dollar strength has been running for quite some time. Do you think this can continue?
My view is that in terms of, I mean, last week, Powell just raised the likelihood of last Friday of Fed keeping rates elevated levels for a while yet to ensure the sufficient demand reduction to bring price pressures lower. This, while not expected to boost dollars significantly higher, given some expectations for hawkish Fed prior, actually may lend dollar some resilience yet, I think, for the next several months. So in that case, until more discernible signs of Fed growth moderation, especially jitters in the job markets, lead to reemergence of bets on Fed dovish tilt or the pivot side of things, we think that the dollar strength could continue to take some support going forward over the next few months, or at the very least the next 4 weeks in our view.
Thanks, Andy. We'll move to Thailand. We have Han to update us on Thailand equities. Han, how has the market performed so far? You mentioned in your report foreign inflow has been strong this year. Do you expect more upside? And can you share with us your sector recommendation?
Morning, Winson. Yeah, in terms of Thai stock market performance, this year has actually been doing quite well if you compare against other MSCI Asian and Japan countries. MSCI Thailand is negative 2% in US dollar returns this year, which puts it just behind MSCI Indonesia's positive 7% return this year. We are actually expecting more upside, and this is mainly due to foreign flows, because if you look at historically, there's a high correlation in terms of Thai stock market return to foreign flows. And we think that there may be a further room for all these net inflows that we observed this year to further increase, because if you look back into period from 2017 to 2021, there was a total net outflow of 21 billion US dollar, where compared against year-to-date net inflow is only US 3.6 billion. And this indicates that it may just only be the beginning of the net foreign inflows. And also, if you look at the foreign participation of the daily trading volume, this year it has increased to 45%. This compared against only a 26% in 2016, which indicates that foreign participation, this is going to have an increasing influence on the Thai stock market. And in terms of sectors, we like sectors which are attractively valued and sectors where foreign active funds are currently overweight. And this would include banks, consumer staples, and energy.
On portfolio strategy, I think you constructed a few model portfolio. Which one is your top recommendation? And is there one that can provide better resilience in the event of a US economic slowdown?
our top pick is a value model portfolio because value in Thailand has been lagging behind the performance of growth. If you look at its year-to-date performance, it has underperformed growth by 3.5%. This is very different from the value versus growth outperformance that we witnessed in Asia ex-Japan and also in ASEAN countries. So we expect the performance of value stocks in Thailand to catch up to this value versus growth outperformance that we witnessed. And in terms of in the event that there's a US economic downturn, our portfolio choice will depend on how severe that the downturn could be, and also how much ASEAN economies have actually decoupled from the US economy. Of course, in the event of a less severe economic downturn, we think that the flows into the net flows into ASEAN could actually continue, and value portfolio will still be our preferred choice because of its high allocation to sectors which are currently preferred by foreign active funds. And of course, if it turns into a more severe downturn, then maybe one could look at portfolios such as high quality and low volatility portfolios, where we expect stocks with higher earnings quality and stocks with lower volatility and lower beta to outperform the market.
Okay, thanks, Han. We'll move to Samuel. Last week, Grab reported its second quarter financial results, and you have a sell call on the stock. Why is it the case? Is the business outlook still challenging, and where do you think Grab stand in comparison with its competitors?
Yes, Winson, we have a sell call on the stock, but we have increased the target price from $2.29 to $2.83, as we see that Grab is making progress on profitability. 2Q22 adjusted EBITDA as a percentage of GMV, gross merchandise value, improved for the third consecutive quarter to negative 4.6% from negative 6% last quarter. Grab's mobility EBITDA margin of 12% on GMV is higher than Uber's 6%. Its improvement from last quarter has given us the confidence to switch to Uber as the peer from Lyft, resulting in an increase of the EV sales multiple from 1.1 times to 1.8 times. On the delivery front, we have studied a universe of food delivery companies, and correlation between profitability and EBITDA as a percentage of GMV has emerged, with more profitable companies being rewarded for higher profitability. Grab's 2Q22 results of negative 1.4% of GMV is better than Deliveroo and Delivery Hero, but comparable to Just Eat Takeaway. So far in our universe of general delivery peers, only Uber and Meituan have been profitable on an EBITDA as a percent of GMV basis. We see that the grocery delivery business that Grab has ventured into has good profitability potential, with HelloFresh registering a 6% EBITDA as a percentage of GMV. However, at the cost of profitability, Grab has increased commission rates and decreased incentives, and this has come at the cost of growth potential. Grab's guidance for next quarter indicates a shrinkage of negative 3% to a stagnant 1% growth of GMV. On the super app front, we studied super apps across Asia in our report titled Super App: The Battle for ASEAN Hegemony. Grab is lagging behind its peers in mini apps development, which is an asset-light strategy that WeChat and Alipay pioneered with much success in China. Grab announced this super app strategy 4 years ago and has made no progress on mini app development, favoring acquisitions and organic investments to accomplish its everyday, everything agenda, which is highly capital intensive. Risks have mounted following the Russia-Ukraine war and Fed hikes, which prompted our initial downgrade of Grab from buy to sell. While its mobility business will be more resilient, delivery services are consumer discretionary, and their rapid slowdown this quarter is a sign that macro and idiosyncratic factors are weighing on this segment. In particular, food inflation is at all-time high based on the FAO index. Droughts in Europe, US and China, and a fertilizer shortage could compromise global harvest next year and worsen the situation. Grab's decline since 4Q21 can be attributed to rising interest rates. However, the inverse relationship between with 10-year Treasury yields and correlation to 10-year, 2-year Treasury spreads are beginning to weaken or break. Overall, fundamentals are increasingly becoming more important than macro factors such as rising interest rates. We want to also note that Grab's insolvency risks are increasing. Our forecast suggests that Grab may have to raise capital in 2024, not to mention the capital burden of digital bank investments in Malaysia and Singapore, which will have minimal capital requirements to meet in 3 to 5 years of close to 1 billion Singapore dollars. Even after incorporating our optimism on profitability, our target price of $2.83 is still below where Grab is currently trading. As such, we are maintaining our sell call.
Okay, thanks, Samuel. Thanks everyone for joining the call. Have a good week.
Download the reports discussed at our Maybank Trade app or speak to your trading rep. Happy trading. I'm Noelle Lim on ASEAN Speaks by Maybank.